You think you're picking a safe ETF. You're actually picking a financial personality. Put $10,000 into VTI, QQQM, or DGRO today, and in 20 years, the gap between the worst and best choice could exceed $38,000 on the same starting amount. Same market, different bet. This video shows you exactly which one is built to pay your rent. If you're new here, this channel breaks down dividend ETFs and long-term investing strategies using real numbers, no fluff, no hype. If that's the kind of content you've been looking for, hit subscribe and tap the bell so you catch every video we drop. Meet Detective. Detective has $10,000 sitting in a brokerage account and 3 ETFs on his shortlist: VTI, QQQM, DGRO. He's done the basic research. They're all diversified, all low cost, all reputable. And here's the thing, that's exactly where most people stop. Detective doesn't. Detective pulls up the expense ratios first. VTI charges 0.03%. QQQM charges 0.15%. DGRO charges 0.08%. On $10,000, that's $3, $15, and $8 per year, respectively. The differences look laughable. $12 separating the cheapest from the most expensive. If fees were everything, this video would be over. But fees aren't everything. So why isn't it over? Detective does what most people don't. He looks inside the funds. VTI tracks the CRSP U.S. Total Market Index. That's roughly 3,700 companies, every size, every sector. You're buying America, all of it. QQQM tracks the NASDAQ 100. 100 companies, no financials, heavy tech. You're buying innovation's front row. DGRO tracks the Morningstar U.S. Dividend Growth Index. Around 400 companies selected specifically for consistent dividend growth. You're buying discipline. Same asset class, completely different bets. Here's where it gets real. VTI's top 10 holdings represent about 27% of the fund. QQQM's top 10, nearly 50%. DGRO's top 10 sit around 30%. Same money, same 10-year window, different concentration. That concentration is the variable most investors never measure, and it's the one that moves your final number the most. Now let's run the actual math. Stay with me. We're starting with $10,000, no additional contributions, just letting it compound. Over the past decade, VTI has averaged approximately 11.6% annualized returns. QQQM's underlying index averaged roughly 17.5%. DGRO has delivered around 12.8% annualized. Year 1, VTI turns $10,000 into $11,160. QQQM becomes $11,750. DGRO hits $11,280. The gap looks small, $40 between VTI and DGRO, about $590 separating VTI and QQQM. That's the trap. Small gaps early feel irrelevant. They are not irrelevant. That's what compounding does when you give it time. It turns $40 into something that pays your rent. Year 10, VTI's $10,000 is now $29,960. DGRO has grown to $33,480. QQQM sits at $49,900. The gap between VTI and QQQM is now $19,940. That's almost double your starting investment just sitting in the difference between two choices. And here's the thing, DGRO is already $3,520 ahead of VTI on the same money, same decade, different index. So now we know the fees are irrelevant to the conversation. The composition is everything. Year 20, VTI reaches $89,760. DGRO compounds to $112,090. QQQM explodes to $248,000. The $38,000 gap I mentioned in the opening, that's just VTI versus DGRO. QQQM is playing an entirely different game. The bet paid, but which bet is right for Detective and for you depends on something the numbers cannot answer. Look at what's actually happening here. QQQM's performance is real, but it's riding concentration risk. Apple, Microsoft, Nvidia, Meta, Amazon. 5 companies drive a disproportionate share of those returns. When those companies win, QQQM wins enormously. When they stumble, QQQM feels it first and hardest. In 2022, the NASDAQ 100 dropped over 32%. VTI dropped around 19%. DGRO fell approximately 9%. Same year, same market, 3 different experiences. DGRO's dividend growth mandate forces it into companies with consistent earnings, strong cash flow, and proven payout histories. That filter is a shock absorber. VTI spreads risk across 3,700 names, but carries the tech weight too, just diluted. 3 funds, 3 philosophies, 3 relationships with volatility. So which one actually pays your rent? Detective thinks about this differently now. He reframes the question. It's not which ETF returns the most in a spreadsheet. It's which ETF he can hold without panic selling when the market drops 30%. Because the investor who holds QQQM through a crash and doesn't sell captures every dollar of that $248,000. The investor who sells at the bottom captures nothing. DGRO's dividend component matters here, currently yielding around 2.4%. On $10,000, that's $240 today. Modest, but Detective isn't thinking about today. At year 20, DGRO's projected value of $112,090 at a 2.4% yield becomes $2,690 annually. That's $224 per month. Not full rent yet, but it's a real number. It compounds further. It's growing. VTI yields roughly 1.3%. QQQM yields near 0.6%. The income streams are not close. Here's the verdict. Detective runs his final numbers and lands on 3 labels. VTI was the diversified bet. You're buying the entire American economy, accepting average returns in exchange for maximum diversification and reasonable income. The patient choice. DGRO was the income bet. Lower ceiling, higher floor. Dividend growth discipline creates compounding income that eventually becomes a real monthly check. Built for investors who want their portfolio to eventually work like a paycheck. QQQM was the conviction bet. You're betting that innovation-driven companies continue dominating wealth creation over the next 2 decades. Higher reward, higher volatility, almost no income. Built for investors with iron stomachs and long time horizons who don't need dividends now. 3 funds, 3 investor personalities, 1 right answer for each person, 0 right answers for everyone. The label hides the bet, and the bet is what compounds. If this breakdown helped you think more clearly about your ETF decision, hit the like button. It tells the algorithm this content is worth sharing. Forward this video to someone deciding between these exact 3 funds right now. And if you haven't subscribed yet, now's the time. Next video, I'm running this same $10,000 through SCHD, VYM, and JEPI to find out which dividend ETF actually replaces a paycheck fastest. Same formula, bigger income numbers. See you there.